All right, this YouTube video is going to cover Kimmel text financial accounting, reporting and analyzing liabilities, and this is chapter 10 in your textbook. And as we've done previously, this is going to be a voiceover PowerPoint. So let's pull up the PowerPoint presentation. I will share my screen, and we'll begin the PowerPoint presentation. Again, this is chapter 10, reporting and analyzing liabilities. So the main items that we're going to take a look at is explain how to account for current liabilities. We'll talk about the definition of current liabilities. Describe the major characteristics of bonds. Number 3, we're going to explain how to account for bond transactions. And lastly, discuss how liabilities are reported and analyzed on the balance sheet. Explain how to account for current liabilities. Current liability, a debt that a company expects to pay from existing current assets or through the creation of other current liabilities, and within 1 year of the operating cycle, whichever is longer. Okay, very similar to the definition of a current asset, but this is a current liability. Okay, within 1 year or the operating cycle, whichever is longer. And typically, we're looking at one year. Current liabilities include notes payable, parts of notes payable, accounts payable, unearned revenue, and accrued liabilities such as taxes, salaries, wages, and interest. Question for you: to be classified as a current liability, a debt must be expected to be paid, satisfied, within what, 1 year? The operating cycle, 2 years? How about D, A or B, whichever is longer, right? 1 year or the operating cycle. Notes payable, written, that's the operative word here, written promissory note, usually requires the buyer to pay interest, frequently issued to meet short-term financing needs, issued for varying periods of time, 6 months, a year, 5 years. Usually classified as a current liability if due for payment within 1 year of the balance sheet date. A note payable may have a current portion and a long-term portion, which we'll see later on. Accounting for notes payable. Again, remember, financial accounting is about recording transactions, about understanding transactions and recording that transaction. First National Bank agrees to lend $100,000 on September 1, 2022. Dates are important. If Cole Williams Company signs a $100,000, 12%, remember the interest rate is always assumed to be an annual percentage rate unless otherwise stated. 4-month note maturing on January 1. When a company issues an interest-bearing note, the amount of assets it receives generally equals the note's face value. So there's the transaction to record the receipt of the cash and the promise to pay. Increase the asset, cash, increase the liability, notes payable. If Cole Company prepares financial statements annually, it makes an adjusting entry at December 31st. Remember what an adjusting journal entry is. It's not a correcting entry, it's an adjustment. It always affects an income statement account and a balance sheet account, but never cash. So we need to accrue the interest. So the dates are very important. And more importantly, we have to put the interest expense in the correct accounting period, the period in which it was incurred. So the face amount of the note was $100,000. The annual interest rate is 12%. And that note was outstanding for 4 months, September, October, November, and December. Although it's going to be paid on January 1 of the following year, we need to put the interest expense in the correct accounting period. Debit interest expense, credit the payable. At the maturity date, January 1, 2023, Cole Williams must pay the face value of the note plus the interest. I'm going to reduce the note payable with a debit. I'm going to reduce cash with a credit, and we're going to satisfy the obligation for the interest payable. What's important here is that there is no interest expense incurred. There's no interest expense in 2023. All the interest appears in 2022. We use the adjusting journal entry to get it there. Sales tax payable. Sales taxes are expressed as a stated percentage of the sales price. We've all seen sales tax. We buy something in a store. If it's subject to sales tax, you pay the sales price plus the sales tax. The selling company acts as an agent for the state. They collect the tax from the customer and then send it to the State Department of Revenue. Here's an example. On March 25th, cash register readings for Cooley Grocery show sales of $10,000 and sales tax of $600 based on the sales tax rate of 6%. Here's the journal entry. So what's important to understand here is that the sales revenue is only for the sales price and not the sales tax. They received cash of $10,600, but $10,000 was revenue, goes on the income statement. Sales tax payable is a liability, shows up on the balance sheet. What if sales are not rung up separately on the cash register? What if sales taxes are not rung up separately? So we got to figure out what the sales taxes were. Cooley Grocery rings up total receipts, total collections of $10,600 and has a 6% sales tax rate. Because the amount received from the sale is equal to the sales price, 100% plus 6% of sales, the journal entry is the following. So it's the same journal entry, but you had to figure out what the amount of the sales tax were. And that's the formula. The total sales, the total cash collected was $10,600, but it included the 6% sales tax. You divide it by 1.06. Unearned revenues, and we saw unearned revenues towards the beginning of the course. Unearned revenues, revenues that are received before goods are delivered or services are performed. Unearned, it's an obligation to perform. Company increases or debits cash, and increases or credits a current liability, obligation to perform, unearned revenue. When the company recognizes the revenue, and we talked about that, when the performance obligation is satisfied, it decreases or debits the unearned revenue account and increases the revenue account. What types of business is this? Well, it typically happens when a customer pays something before the services are performed. Airline tickets, pay for my airline tickets before I travel. Magazines, I pay for magazines before, and hotels. Superior University sells 10,000 season football tickets at $50 each for its 5-game home schedule. On August 6th, when they collect the cash, they debit cash, credit the unearned ticket revenue, unearned, collected in advance. As each game is completed, right, there's 5 games, Superior records the earning of the revenue, reduce the unearned revenue with a debit, credit ticket revenue goes on the income statement when it's earned. Current maturities of long-term debt. Remember we talked about a note payable that might be 5 years. Well, in order to prepare a classified balance sheet, we need to separate between the current liability and the long-term liability. Illustration, Wendy Construction issues a 5-year interest-bearing $25,000 note on January 1, 2022. This note specifies that each January 1, starting January 1, 2023, Wendy should pay $5,000 of the note. That's the principal portion. When the company prepares financial statements on December 31st, 2022, what amount should be reported as a current liability? What is payable within 1 year? $5,000. What's the long-term portion to be paid outside of the first year? $20,000. You and several classmates are studying for the next accounting examination. Answer the following questions. If cash is borrowed on a $50,000 6-month 12% note on September 1, dates are important, how much interest expense will be incurred on December 31st? Principal times rate times time. Principal is $50,000. The annual interest rate is 12%, but that note is only outstanding for 4 months, September, October, November, and December, 4/12. Interest expense is $2,000. Answer the following questions. How is the sales tax amount determined when the cash register total includes sales tax? The total collected divided by 100 plus the sales tax rate. Therefore, the sales tax is $1,320. If $15,000 is collected in advance on November 1 for 3 months' rent, what amount of rent revenue should be recognized by December 31st? How much rent did they earn? November and December. 2 of the 3 months. $10,000. Everybody's received a payroll check. What's going on with payroll? It's a liability. The term payroll pertains to both salaries and wages. Determining payroll involves computing gross earnings, payroll deductions, and net pay. Assume Cargo Corporation records its payroll for the week of March 7th as follows. So on March 7th, they have a $100,000 payroll expense, but the employee doesn't receive the whole $100,000. The employee receives a net check, net after what? Net after FICA, which is Social Security and Medicare, less federal income taxes and less state income taxes. That first entry, you can see, although the salary expense is $100,000, there are withholdings that result in a net pay to the employees of $67,564. Those other obligations are withholdings, monies that were taken from the employee's paycheck that the company owes to the federal government and state government. When they make the pay, when they pay, actually disperse the cash to their employees, they have that second journal entry there where they reduce the obligation and reduce cash. Payroll tax expense, okay, versus payroll, okay, so you got salaries and wage expense, and then you got payroll tax expense from a company's perspective, results from 3 taxes that a governmental agencies levy on employers, the company. These taxes include FICA tax, which is Social Security and Medicare tax, federal unemployment tax, and state unemployment tax. Based on Cargo Corp's $100,000 payroll, the company would record the employer's payroll tax expense and liability for these payroll taxes on March 7th as follows. FICA tax, which is Social Security and Medicare, the employer portion is 7.65%. The federal unemployment is 0.8%, and they're telling you that the state unemployment tax, which changes by state and changes by company, of $5,400, they have an expense of $13,850, and those payables. Employer payroll taxes do not include C, federal income taxes. Those other 3 are employer taxes. There's a distinction. Employee tax, that's what the employee pays, that comes as withholding, resulting in a net check. And then there's employer tax, only the employer pays it. Here's another example. During September, Lake Corporation employees earned wages of $60,000. Withholdings related to these wages were $45.90 for FICA, $6,500 for federal income tax, $2,000 for state income tax. Costs incurred for unemployment taxes were $90 federal, $150 for state. Prepare the journal entries for A, salaries and wages expense. So that first entry there is the salaries and wage expense, $60,000. Social Security and Medicare is 7.65% for the employee, 7.65% for the employer. It's a matched amount. Employee pays for half, employer pays for the other half. In this example, the net check to the employee is $46,910. Here's the employer tax. Remember, the FICA taxes payable is 7.65% for the employee and the employer. It's the same amount for both, right? Here's what the employee paid from their paycheck, $45.90. Here's what the employer paid, $45.90 as well. Let's talk about bonds. What are bonds? A form of interest-bearing notes payable issued by corporations, universities, and government agencies, sold in small denominations and large denominations. So bonds are also an investment from an investor. So although the university or the corporation issues the bonds, somebody buys those bonds with the idea of earning interest. It's an investment. When a corporation issues bonds, it is borrowing the money. The person who buys the bonds is the bondholder. They're the investor. They're lending the money. We have two types of bonds. A secured bond. They have specific assets of issuer pledged as collateral for the bond. So if the corporation or the university does not make the payment, the bondholder can go after the assets that were pledged. Secured bond. Unsecured bond are issued against general credit of the borrower. No collateral. Convertible and callable bonds. Convertible bonds, they can convert to what can be converted into common stock at the bondholder's option. A callable bond can be redeemed by issuing company prior to maturity at a stated dollar amount. Convertible versus callable. A bond certificate, it's kind of like a promissory note. Bond certificate is issued to the investor, provides for the name, face value, maturity date, contractual or stated interest rate, face value, etc. The contractual interest rate is the annual rate used to determine the cash interest paid. This is an example of what a bond certificate would look like, which provides all the necessary details. Contractual interest rate, which we're going to see is going to be different than the market interest rate. Bond trading. Bondholders can sell their bonds at any time on a national securities exchange. Prices are quoted as a percentage of the face value of the note, of the bond. Corporation makes journal entries only when it issues or buys back at bonds, or when bondholders convert bonds into common stock. Market information for bonds. Here's an example. Determining the price of the bond. Now, we're not going to actually do that, okay? But essentially, the short answer is, how do you determine the price of the bond? It's the present value of all the cash flows. And there are two significant cash flows associated with a bond. It's the maturity value and the interest payments. Maturity value happens once, and the interest payments happen as frequently as quarterly. And you need to know the interest rate to discount it. Discounting, the process of finding the present value of the bonds, removing interest from the future bond cash flow. So we're not going to cover that. It's not in this chapter. We're not going to do the present value of a bond. Assume that Acropolis Company on January 1, 2022 issues $100,000 of 9% bonds due in 5 years with interest payable annually at year end. They're telling you present value, what that's worth right now. Because let's face it, that $100,000 is going to come back 5 years from now. What is it worth right now? Depends what the interest rate is. So it's present value of the $100,000 in 5 years. They're telling you it's $64,993. The present value of the $9,000 received annually is not $9,000 times 5 years at $45,000. No, because it's discounted, it's only worth $35,000. Present value of the future cash flows. The principal plus the interest, $100,000. Bond terminology. Indicate whether each of the following statements is true or false. Mortgage bonds and sinking funds are both examples of secured bonds. True. Unsecured bonds are also known as debenture bonds. True. The contractual interest rate is the rate investors demand for loaning funds. No. The contractual interest rate is the amount of cash that's paid according to the bond. The face value is the amount of principal the issuing company must pay at the maturity date. That's true. The market price of a bond is equal to its maturity value. That's false. We're going to see why. How to account for bond transactions. A corporation records bond transactions when it issues or sells or redeems, buys back that is, bonds, or the bondholders convert bonds into common stock. Bonds may be issued at face value, below face value, which is a discount, or above face value, which is a premium. Bond prices are quoted as a percentage of the face value. The market interest rate. So there's a difference between the contractual interest rate and the market interest rate. The contractual interest rate is what is printed on the bond and what is going to be paid in cash at every interest payment date. The market interest rate is what? Is the contractual interest rate used to determine the amount of cash interest paid by the borrower? No. Is it listed on the bond debenture? No. Is the rate investors demand for loaning funds? That is correct. Contractual versus market. Candlestick Inc. issues 100 5-year 10% $1,000 bonds dated January 1, 2022 at 100, which is a percentage of the face value. When they issue the bonds, there's your transaction. They receive cash, they have an obligation to pay the bond payable. At the end of the first year, again, we got to put interest expense in the correct period. The bond was issued at face value, so therefore we can use the contractual interest rate, debit interest expense, credit interest payable. It's an adjusting journal entry. Journal entry to be made by candlestick to pay the interest the following day. Right? You got to put the adjusting journal entry on the previous slide, on this slide right here, puts the interest expense in the correct accounting period. Discount of premiums. So when there is a difference between the contractual interest rate and the market interest rate, you're going to have either a premium or a discount. If the contractual interest rate is 10%, but the market interest rate is only 8%, those bonds are going to sell at a premium. They're going to sell at more than the face value, more than 100%. If the contractual interest rate is exactly equal to the market interest rate, that bond's going to sell at its face value or at 100. If the contractual interest rate is less than the market interest rate, that bond is going to sell at a discount in order to give the investor the return that they demand. Laurel Inc. issues 10-year bonds with a maturity value of $200,000. If the bonds are issued at a premium, this indicates that what? The contractual interest rate exceeds the market interest rate. Assume that on January 1, 2022, Candlestick Inc. sells $100,000, 5-year 10% bonds at 98. They sell it at a discount, less than the face. What's the journal entry? So you got to say to yourself, well, the bond payable stays at $100,000. How much cash did they receive? Well, they sold it at a discount. They only received 98% of the face. They received $98,000. In order to make this journal entry balance, your debits have to equal your credits. You need a debit for $2,000. It's called a discount on bonds. This is what the income statement, this is what the balance sheet looks like. Bonds payable $100,000, sold at a discount. Right now, they only have a payable $98,000. Issuing corporation must pay the contractual interest payments over the term of the bonds and the face value of the bonds at maturity. Total cost of borrowing. So we have this bond discount on the books. We need to amortize it over the life of the bond. That discount is going to be allocated to expense in each period. Increases the amount of interest expense reported each period, because remember, the bondholder is going to receive the contractual amount of interest on the payment date, not the market. The premium or discount accounted for the differential. The amount of interest expense reported each period will exceed the contractual amount paid. As the discount is amortized, its balance declines. The carrying value of the bonds will increase until at maturity, carrying value of the bonds equals their face value, brings it up to the $100,000 amount. What if it's issued at a premium more than the face value? Assume that Candlestick Inc. bonds previously described sell at 102 and not 98. They receive more cash than the face. They receive 102, 102% of the bond. They receive $102,000 of cash. They still have the bond payable at $100,000. That's not changing. But they've got a premium of $2,000. Debits have to equal your credits. This is what the balance sheet looks like now, right? More than $100,000. There's your cost of borrowing analysis. You see the amortization of the premium decreases the amount of interest. How do we amortize it? Allocation to expense each period decreases the amount of interest expense reported each period. Very similar to the discount, but this time it decreases the interest period. Here's an example. Giant Corporation issues $200,000 of bonds for $189,000. The journal entry to record the issuance of the bonds is as follows. So they didn't tell you it was a percentage of face, they just told you it was for 189. That's the journal entry to record the transaction. This is what it looks like on the balance sheet. Candlestick records the redemption of bonds at maturity. The discount is gone because by then they have amortized the discount. It's gone. Redeeming bonds before maturity. When a company retires bonds before they mature, it is necessary to, one, eliminate the carrying value of the bonds at the redemption date, right? We got to get rid of the bond. Record the cash paid. Recognize any gain or loss. The carrying value of the bonds at redemption date. Carrying value, right? Face value versus premium or discount. So the face value of the bonds less unamortized discount, or face value of the bonds plus unamortized premium. Here's an example. At the end of the fourth period, Candlestick Inc., having sold its bonds at a premium, retires the bonds at 103% of the face value after paying the annual interest. The carrying value of the bonds at the redemption date is $100,400. The unamortized premium at that point in time is $400. Candlestick records redemption as follows. So the key is put in what you know. Okay, you know you're going to get rid of the face value of the bonds, going to debit that for $100,000. You also know you're going to get rid of the premium of $400. You're going to have a credit to cash because you know you got $103,000. The piece that you may not know is the loss on the bond redemption. Again, remember, your debits have to equal your credits. You need a debit for $2,600. A debit is an indication of an expense or a loss. Loss on bond redemption. Another example, R&B issued 500,000 10-year bonds at a discount prior to maturity. When the carrying value of the bonds was $496, the company redeems the bonds at $98. 98 of what? 98 of the face value. So again, they're going to remove the bond payable at its face, so you're going to debit the bond payable for $500,000. You know you got to get rid of the discount on bonds because you know the carrying value of the bonds is $496. So 500 minus 4 is 496. So you know you had a debit balance in the discount account for 4,000. You got to get rid of it, so you're going to credit it for 4,000. You know you received cash at 98 of the face. 500,000 times 98 is 490. Your debits have to equal your credits. You need a credit. Credit is an indication of revenue or a gain. Gain on bond redemption, $6,000. Discuss how liabilities are reported and analyzed. So here's what the liability section of a balance sheet looks like. You got your current liabilities, you got your long-term liabilities, notes payable, assumed it's all current, right? If there was a long-term portion to it, the long-term portion would be in the long-term liability section. Accounts payable. So here's the current maturities of the long-term debt. Accrued liability. So that's what a liability section looks like. General Motors, here's a comparative balance sheet. It's in millions. Got certain assets, some liabilities. Here's some liquidity ratios you're responsible for. The current ratio, which you're familiar with, current assets divided by current liabilities. You can see the liquidity is exactly the same, hasn't changed. 80, less than 1-to-1, not good. You always want to see something greater than 1-to-1. Liquidity ratios measure the short-term ability of a company to pay its maturing obligations and to meet unexpected needs for cash. Solvency ratio, debt to assets ratio is the most important one. Total liabilities divided by total assets. And you can see here that their total assets and total liabilities divided by total assets is increasing. Not by much, but it's going the wrong way. Ideally, you want to see that go down, but it's going up. Times interest earned. Contingencies. So these are things that could happen. Do they need to be recorded? Do they need to record a liability for something that could happen. Events with uncertain outcomes that may represent potential liabilities. Common types of contingencies, lawsuits. What if a company is sued? Do they have to record the liability? Product warranties. We're not going to cover that. You're not going to see that, but do you need to record the possibility of product warranties? Accounting rules require that companies disclose contingencies and notes. If you go on to intermediate accounting, you get a much more in-depth analysis of when to record these liabilities. Off-balance sheet financing, just need to know this is an intentional effort by a company to structure its financing arrangements so as to avoid showing liabilities on its balance sheet. Enron's an example of that. Let's analyze the liabilities. Trout Company provides you with the following balance sheet information as of December 31st, 2022. Current assets, current liabilities, long-term assets, long-term liabilities. Trout reported net income for 2022 of $14,000, income tax expense $2,800, interest expense of $900. Compute the current ratio and working capital, right? Current ratio, current assets divided by current liabilities. They got 1.3 assets for every liability. That's good. Working capital, current assets minus current liabilities. They have excess working capital. Again, a good thing. Assume that Trout used $2,000 to pay off a $2,000 accounts payable. What's the impact on current ratio and working capital? Current ratio goes up a little bit, doesn't it? It's now 1.42. What was it before? It was 1.31. So paying down that liability helped the current ratio, but had no change on working capital. Working capital is still the same. Compute the debt to assets ratio. %69% of their assets is encumbered, if you will, by liabilities. So we talked about the premium and discount. How do we increase expense, or how do we reduce interest expense? So we need to amortize it. Now, there's two different ways to amortize it. The first one is the straight line method. The second one is the effective interest method. You're supposed to use the effective interest method if it's materially different than the straight line method. The effective interest method is GAAP, but we're not going to bother with that one. It's a little too complex for financial accounting. It's intermediate accounting concept. But working with the straight line method at least illustrates the process that's used to amortize premium and discount. So amortizing a bond discount. To follow the expense recognition principle, companies allocate bond discount to expense in each period in which the bonds are outstanding. You got to put it in the correct accounting period, right? So you take the total bond discount divided by the number of interest payments, and that's the bond discount amortization. So it's going to be the same amount every period. It's straight line. It's simple. For example, Candlestick Inc. sold 100,000 5-year 10% bonds on January 1, 2022 at 98, resulting in a $2,000 discount. Interest is payable on January 1 of each year. So on journal entry to accrue the interest and amortize the bond discount. So you got to put the interest expense in the correct accounting period. So you need an adjusting journal entry on December 31st, 2022 to accrue interest. Now, what's important here is that the interest payable or the cash going out is always the contractual rate. Whatever the contractual interest rate is, that's the amount of cash that is dispersed. So in our example, $100,000 bond, 10% per year. The interest payable, the cash to be paid is $10,000. That's always the same. The payable or the cash disbursed is equal to the contractual rate multiplied times the face. However, because there is a discount here, the bond was issued at a discount. The bondholder, the interest expense, the carrying value is actually higher than the contractual rate. So when we amortize the bond, we amortize the discount. That $2,000 discount is amortized over a 5-year period. So $2,000 discount divided by 5 years, you're amortizing at a rate of $400 per year. The discount was an initial debit balance. When you amortize it, you're going to credit it. So you credit the discount for $400. Your debits have to equal your credits. The debit to the interest expense is $10,400. This is the amortization schedule for the bond. The amortization schedule, which includes interest expense and the amortization of the discount. $400 a year for 5 years, $2,000. Very straightforward, right? What about a premium? Amortizing the bond premium. Candlestick Inc. sold 100,000 5-year 10% bonds, right? Same thing on January 1, except this time at a premium at 102. Again, the premium was $2,000. The bond is for 5 years. The premium amortization is $400 a year. So let's look at this journal entry. They're still going to pay out the contractual interest at 10% times $100,000. They're going to have a payable at $10,000. That's the credit. That's the easy part. You also know that you need to bring down the balance of the premium. The premium had an initial credit balance. In order to bring it down, you're going to debit it. You're going to debit the premium for $400. The interest expense, it's going to be a debit, you know that, but for how much? Well, your debits have to equal your credits. You know you need $9,600 debit. That's where you got the number from, in order to make the debits equal the credits. Here's the amortization schedule for the premium. Again, $2,000 premium, 5 years, $400 per year. So this next section here is the effective interest method for amortizing bond discount premium, which we are not going to cover. And that's all we have for Chapter 10, reporting and analyzing liabilities. Thank you.